Good morning, good afternoon, good evening, depending on what part of the world you're in. Welcome to Venture Outfitter Weekly. I'm Kevin Koym, founder of Tech Ranch. What we'll be doing is we've got a really special program today. We're going to hear from Joe Milam. And we were just sharing some Texas stories right before we got started. We'll be going back and forth, and I'll go ahead and mention this. I'm going to go through some slides before I officially introduce them. But one of the things that as you come on and all that sort of stuff and you like to interact, Joe's style, he's already told me he likes to be very interactive. So if you have a question, part of what we'll do is I'm going to ask you to raise your digital hand when we get to that part of the show. But part of the reason we're here today is the Venture Outfitter is a program that has several different organizations involved in it around the world. But I'm the founder of Tech Ranch, but the Venture Outfitter is this organization that we're building across the world for supporting entrepreneurs that are building ventures to drive impact on the world. And so we'll be going through that. Yeah, I'll be telling you a couple of different times about how to get involved for some of you that are here for the very first time. One of the quick answers to that is if you go to techranch.com/connect, there's a bunch of connect points to connect into our larger community and things like that. So let me hop in with a few slides and then we'll get to Joe. So I started my first business almost 30 years ago in Guadalajara, Mexico. And many of you know that I have been really bullish on Mexico for a very long time. And in fact, over the last few weeks, we've been telling you about some of the bridge that we're building with the state of Chihuahua. Mexico is exploding right now because of all the opportunity. In fact, earlier this week, Mexico surpassed China as the top U.S. trading partner. Now, for those of you all that are Texan, you know that Mexico has been buttering Mexico has been buttering Texas's bread for a very long time, and same thing about Texas to Mexico. The number one trading partners for the state of Texas and the country of Mexico has been Texas back and forth, but now this is actually happening at the U.S. level. It's pretty exciting because of those first experiences. I think it's great to see, and I think it's important for us as Austinites and as well as Texans, as well as those of you that are connecting to this part of the world, to know that part of the reason you want to connect into Texas, it's to get access to the business that's exploding in Mexico. And today's sponsor, in fact, is a company called eKepler. eKepler is one of the Tech Ranch. I think they were involved in Tech Ranch programs almost 12 years ago. But eKepler helps companies manage the cross-border operations between Mexico and the United States. And so the main thing about that is there are special accounting laws that you have to work within in Mexico. This organization has the systems for being able to do that. So for those of you that have supply chains that are going into Mexico, perhaps they used to be into China, but you're switching over because a lot of that activity is happening right now. eKepler would be great to tie into. If you're interested in hearing more on today's show notes, we'll make sure that we have points of contact into eKepler. And thank you to Enrique and his team for being sponsors, for long-term sponsors of the Tech Ranch. So switching gears, Tech Ranch has a attached nonprofit, a 501c3, and there's been a call for board members. The board is now launching a number of different things. After COVID, we're dusting things off. There's a lot of activity that's happening. You can see some of the photos that were taken and some of the projects that the nonprofit has done around the world. We have a nonprofit and a for-profit, but part of what's been happening is we've been articulating this network of entrepreneurs around the world. And a lot of times, some of the for-profit entrepreneurs are actually leveraging their technologies and tools into solving problems in these other countries and vice versa. You know, it's not just US centric. If you're interested in being either a volunteer involved with a nonprofit or possibly interested in the board, we're actually going to be building up the board to the next level because of the type of projects that the nonprofit is taking on. I'm chairman of the board of the nonprofit. There's a lot of information that we can tell you more about it, but if you're interested, the place to go is go to the community website, look for the post that says board members for a nonprofit in the request channel and take advantage of that. You can go directly to the QR code. Or if you want to read more about the nonprofit, go to ventureaccess.ngo. So TechRich has been building bridges around the world. Here's some of the bridges, everything from the federal government of Mexico, the national government of Italy, with Russia, with the Eurasia Foundation. Sadly, that, I would have preferred that type of work that we did would have prevented the things that are happening between Russia and Ukraine right now. 2020 and 2021, we went virtual with our activities, supporting the Texas Global Health Security Initiative, launching bridges with the country of Hungary, Czech Republic in 2022, Japan, and other parts of Central America. 2023, we've already announced that we were launching bridges with Austria, the second year with Japan's JETRO, that's the Japan Trade Organizations, and then Chihuahua, Mexico. Part of the idea about this is that to really gain access to markets, large enterprises can just buy their way in, whereas these earlier stage startup scale-up companies can't. Now, in my case, I showed you a slide a few slides ago that said my first customer for my first startup, I was an Austin-based entrepreneur, and I got lucky. And, my first $250,000 customer was a bank in Mexico. Well, so part of the idea about why to articulate these venture bridges is to make sure that entrepreneurs have access. And it's not just one direction. There's also, for those of you that are based in Austin, Texas, and you're looking for access to other parts of the world, you can take advantage of these venture bridges as well. We'll be telling you more about it. Next week's program is going to be how can you take advantage of venture bridges, and I'll go through some specific examples. We'll have a couple of entrepreneurs that have taken advantage of these bridges, so you can kind of get a better idea about why does it matter and how can you take advantage of it business wise. That'll be next week's program. And then the week after, I will be giving a speech at the in Valparaiso, Chile. Chile is where this part of my career started. The first 1,000 entrepreneurs to go through one of our programs. For the organization wasn't called TechRich, that I started 20 years ago. But when I started this part of my career, working with governments and entrepreneurs to help them be successful, I'm kind of excited to get to go back. And it says essentially what the talk is going to be about is driving innovation in entrepreneurial ecosystems. We'll get to do this in the city of Valparaiso. We'll also be doing activities in Santiago de Chile and reconnecting with a lot of the colleagues that I worked with years before. And then on the 7th and the 8th, I'll be in Mendoza, Argentina, working with one of the congressmen there, a gentleman by, well, I'll tell you more about it when we come up to that. We actually have presentations about both of these events. On the 3rd for the Venture Outfitter Weekly, and then on the 10th at 11 a.m. for the activities about what's happening in Argentina. And again, a lot of times you might not imagine it, especially since there a lot of times for US-based entrepreneurs, there's kind of there's like this orientation about, not recognizing the amount of business that's just out there. And I can tell you, at the very beginning of my entrepreneurial career, first startup, my first $250,000 customer was a bank in Mexico. And that's back, 30 years ago when $250,000 was a lot more money than it is now. And so I say that a lot of times your customer, Eric Ries says, you got to get out of the building, right? In his lean startup stuff. I sometimes think for finding business, you got to get out of your country, because there's sometimes ways that you solve things that are interesting in other parts of the world, because you can solve a very specific set of issues there. So on the serious front, many of you know that there's been a lot of really rough stuff that's happened around the tech ranch. I'm not going to go into details about that right now, but we've had some a tragedy or two that's happened, and I want to make sure that I do a shout out. One of the things that happens around the tech ranch is a focus on not just building successful ventures, but making sure that the entrepreneur and that early team have support. We have a channel on the community site called Personal Development. One of the things that my coach, I worked with a guy by the name of Ari Messel, who Tony Robbins calls the most productive guy in the world, right? So the thing that's interesting is Ari was giving me feedback and saying, hey, Kevin, you're a little dysregulated right now. What's going on? Got to get really grounded again. I started doing meditation again. And I mention this because some of you might not have ever been exposed to meditation. But one of the things that I did, I've got exposed to meditation because of my martial arts background. And so I've been doing meditation for more than 20 years. But I got reminded of this based on my coach and his feedback for me. And the thing that that I wanted to mention, one of the simplest ways into supportive processes that you as entrepreneurs can do for free is there's this guy that's lived in Austin before. His name is Hal Elrod. He's got a very interesting story. In the personal development channel, we'll have pointers to his free movie that you can watch on YouTube for free. You don't have to even register or anything like that. He's got a free app that can help you go through what he calls the savers routine. If you're curious about this at all, and it starts with meditation. It starts with 10 minutes of silence. It's not a religious thing or anything like that. It's just a really grounded practice. So I'm redoing this myself, based on the feedback I got from my coach. And I want to make sure that you know about it as well for all the different entrepreneurs that hear about this type of work. So in all seriousness, and this channel is set up for more interactions like that. It's also a great place to ask, hey, I'm looking for the following insight. It could be anything from supplements to, meditation practices to anything that helps you drive your venture farther. So, all right, well, I know a lot of you are here today not to hear me talk about this sort of stuff, although I will push you a little bit about, hey, let's take care of ourselves as we're building our ventures. But we're really here to hear from Joe Milam, who is the founder of Angel Span and also the Legacy Funds. So this guy is an expert in securities and analysis and stuff like that. And part of when I asked him to speak to us today is help us optimize our fundraising possibilities. Okay, what do I mean by that? One of the things that I appreciate about Joe, when we were just talking before the broadcast, I got to meet him about 10 years ago, is he was the first person that I had ever met that in the investment world who was teaching entrepreneurs like myself about how to communicate with your angel investors. And so the thing about it is that a lot of times there's not a lot of support. We all, we have pitch classes and all that sort of stuff, but we don't necessarily have anyone telling us how should we be interacting with our investors and what we should be doing about that. The other thing that he did that I think he has got some really clear models around and that all of us can learn from, and I know that I've learned a lot, is this idea of how to value the startup, but also how do you evaluate the startup as well. And he had an interesting model that he got me to buy this old textbook that was like 1988 when it first got published. We'll ask him about this as he comes on. Let me do a shout out to Jello to say, go ahead and bring Joe on. And Joe and I both like the style, a very interactive kind of just going back and forth. He called it spitballing. What we'll do, since we have a really good studio audience today, and I know on the streaming services we've got a lot of people that I'll be watching. When I look up and to the left, this is me looking at the streams and stuff like that. We're going to do our best to take questions back and forth. I'll ask a few questions. If you have something and you want to actually say it live, you can actually raise your digital hand and I'll do my best to see that. You can also post questions into the meeting chat and I will read them off as we go through things. Let's do this interactive as much as we have. We've got another 40 minutes at least that we can do this back and forth. No question is wrong. Just make sure that you're asking the question that's really going to help you drive your venture, not just, kick tires and stuff like that. Hey, Joe, thank you for joining us today. So I'm excited to have you on because you've taught me a lot about how to interact with investors. Let me just create some space and say, tell us what should we be doing with regards to this? I mean, part of the notes that we sent back and forth is about how to optimize this whole interaction with an investor. Tell us give us kind of an intro and into the whole set of ideas.
Sure. It goes back all the way to my college days. I've been a finance nerd since college, and during college, I didn't know what a hedge fund was, but I could have run one. I had a brokerage account, and people were giving me money, and I just had game. And this is in the early '80s, back when the bull market started. So I certainly had a tailwind to learn and cut my teeth in investing. But I had game, and during college, I read an article about why money stays in European families longer through more generations than American families. And the crux of the article was really drilling down on the psychology of how people view money. And that really started me down that road, and I've been on it ever since. So I've had others suggest I should write a book about this and or label me as maybe the world expert in the psychology of wealth. Why people write checks, whether it's philanthropy or investing or whatever. So that's really the foundational work that informs all the things that we're now trying to bring to the entrepreneurial world, so that the entrepreneurs have a better experience in both raising money and dealing with investors after they've been able to successfully raise money. And equally important, we can improve that process, that information flow and communication flow, so that more money actually gets deployed with greater efficacy, efficiency, and effectiveness. So, I mean, in Texas in particular, but outside of the usual suspects of New York, Boston, and LA, and maybe Chicago, and Silicon Valley, of course, it's hard to find money. And that is colossally stupid. I managed money for 20 plus years, ran a multifamily office, we did our own securities analysis and valuation work. I've been on the board of public companies because of my ability to value private companies and public companies. But, and the process of how entrepreneurs source capital is patently silly when I compared it to how I managed money in the public markets, right? I had access to good information at the individual company level. I didn't need the managements of GE and Cisco and IBM to come parade to my office and pitch me before I decided to buy the stock and put it in our client's portfolio, because I had access to good information. And then in managing money for wealthy folks, originally old money, DuPonts and folks like that, it gave me a laboratory but it was out there at 3000 Sand Hill in Silicon Valley. That's where that money management firm that I joined and eventually took over in the early 90s, that's where it's located. So we managed old money, but we're in the epicenter of this new money wealth creation that became Silicon Valley post the internet commercialization. And so I had this laboratory of applying the psychology in managing money in the public markets, but getting very active early on into private markets and angel investing. And I managed money for two partners of Sequoia Capital, senior executives of Silicon Valley Bank, blah, 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 because back in the late 80s and early 90s, that was just a cottage industry. And these people weren't nearly the rock stars they claim to be today, because VC was still a cottage industry. And then angel investing hadn't even taken off yet in the modern era. And that happened right under my nose as well. So like I said, I've just had this epic series of experiences of exposure to old money and new money, wealth preservation, wealth creation, but having studied the psychology of wealth since college. So that's sort of the framework.
Could you tell us a little bit more about the psychology of wealth? Like, I mean, I get the distinctions at the highest level between the European mentality and the American mentality, but tell us a little bit more. What is that fundamental psychology? What's the what is the dynamic that you're pointing to?
Yeah, I've got an illustration I can provide you, and you can make it as part of the notes if you would like. That's sort of the sum total of the various presentations and writings I've done on this. But if you think in terms of, we created our own, one of the ways we frame this is, if you think of wealth on a classic S curve, where the y-axis is age and the x-axis is money. We built this because it became a framework that we would view all clients that would come to us for us to manage their money. We were an old school multifamily office, so we had all their money, but I want to understand their head. And so I'd always try and view them in the context of the S curve. And we didn't try and put numbers to the age or dollars, because everybody's unique, but their behavior typically follows that S curve in some capacity. And if you then, in that illustration, take that Maslowian pyramid of hierarchy of needs and motivations and turn it on its side, you can very much align the Maslowian pyramid of behavior and motivations with the S curve. We're at the very top of the S curve, where the age and wealth is plateauing, if you will. The wealth is plateauing as people are continuing to age. At that inflection point, past that is you're in the wealth preservation, what I call the legacy phase of your life, where you care more about qualitative than quantitative. Prior to that, as the steep part of the S curve, you're in the wealth accumulation. And if you put that Maslowian pyramid on its side, that separation between ego and self-actualization is right at that inflection point. So everybody falls within the context of that view. I can talk to somebody for 5 minutes and know exactly where they're on their S curve and Maslowian pyramid. I don't care what their net worth is. It has nothing to do with age or money. It has to do with behavior, which is defined by their motivations, which is framed by the Maslowian pyramid. And in the context of their S curve, I can tell you what behaviors they're going to pursue. Because once you're at that, either at the early stages of ego gratification or at the latter stages, and you're seeking self-actualization, that's when people start getting more philanthropic. They get more altruistic. They talk about impact investing, or they talk about wanting to give more to charity, to pay it forward, or to give back, whatever you want to label it. So again, it all comes down, it has nothing to do, and you've got generational issues, and you definitely have gender issues around this as well. And that's what makes it so interesting and dynamic, and it's been so fascinating for now. Christ, I'm 61, so I guess that's 40 plus years I've studied this.
Yeah, wait, that's one of the things. That's one of the things I really appreciate about how you've interacted. I mean, I've seen you speak so many times in Austin, talk about the different ways of looking at that. Is there a way that we as entrepreneurs, as we're looking for funding for our companies and stuff like that, that how should we be using this lens to look at these different investors as part of our process?
Well, there's one additional piece that I would inject in that lens. So if we're thinking in terms of layers of lenses, this is an additional layer. You've got the S curve and you got the Maslowian pyramid, and then you've got what's called prospect theory. Prospect theory won the Nobel Prize in economics in 2002 for Daniel Kahneman. He is also the patron saint and father of the whole concept of Moneyball. He is the patron saint of behavioral economics and behavioral finance. How much psychology influences economic decisions and decision-making processes. And prospect theory says that people's motivations for making a decision, financial or otherwise, the prospects of loss is twice as impactful in their decision-making than the prospects for gain. It has twice as big an impact. Now, that is the first lens you need to view every investor. Now, what are they afraid of losing is where you've got to understand where they lie on their Maslowian pyramid. Because it isn't just money. Wealthy people gave away over $500 billion last year to nonprofits. They were losing all the money. Even after the tax deductions, they were losing all that money. So what prospects for loss was motivating them to write that check that there was a guaranteed 100% prospect for loss of money? So what didn't they want to lose in writing that check? Okay, so this is an example of how you've got to scratch below the surface. Now, distilling that down to an angel investor or a VC, we hear this phrase FOMO. The fear of missing out is that motivation of the prospects for loss, except it's not loss of capital, it's loss of social status or loss of recognition of being in the cool kids club or having found a hot deal as part of their early adopters. It's fear of brand. It's not fear of loss of money. So again, this is where you can peel back the layers of the onion of the psychology. And again, having done it for long enough, I can spot what's somebody's motivation right away. Most investors in early stage startups, fear defines their decision-making, which means this pitching process is absolutely appealing to the wrong thing. That's why it's still so bloody inefficient to raise money, because entrepreneurs have been trained wrong. Because the pitching process is trying to magnify some limbic brain stimulation to fear of missing out on an economic opportunity to make money on this, because you got to be a first mover, you got to hurry, all that sort of urgency, this false sense of urgency that's created that entrepreneurs are trained and coached on, and the decks trying to illustrate, et cetera, et cetera. And that's all wrong. Shocking that it's still so bloody hard to raise money after all these years of entrepreneurs being coached on all those tactics, because the tactics themselves are wrong.
Yeah, it sounds like the whole outlook itself. I mean, it's interesting because I'm one of those coaches, and I recognize that recognizing what you're saying, especially in this context of prospect theory, that makes a lot of sense. It's like, if you know that they've got a fear, especially that shift. One of the things that I want to ask you about, actually, I want to ask you about this first, so that I bring everyone else into something that I know that you said, that you've mentioned in the past that there's some new laws that make it that make investments as attractive, if not more attractive, than charitable giving, like, moving money out of the charitable area into the investment area. Could you actually touch on that? And then I'm going to come back to the question I was just about to ask you. I just want to make sure that others have context before we hop to that next question.
Sure. Yeah, this is really important. And it's two tax laws that have been around a very long time. The first one was passed in 1958. It's called QSBS under Section 1244 of the IRS Code, Qualified Small Business Stock under Section 1244. And what that was part of the investment, Small Business Investment Act of 1958 that launched the venture industry, by the way. So it was the very fiscal stimulus tool as part of the original legislation to launch the venture industry, to de-risk angel investing, the early stages of investing. It applies to taxable investors, whether you are a direct angel investor with your own money or a taxable investor putting your trust money through an LP and a venture fund, it still flows and applies to you. But what the law says, that if you are an investor, and this is the current status of the law, it wasn't the original law, but the current status, is if you're part of the first $1 million of outside money that goes into a startup that qualifies, and it's really easy to qualify. You have to be a C Corp, can't be an LLC, in your corporate formation documents and structure. The term sheet itself has to be an equity instrument. Now, forever, safe notes didn't qualify. And that was evidence that Y Combinator had no idea about QSBS laws when they established that safe note. They changed it in 2018 to be a safe equity instrument and put a legend in their template that says, for tax purposes, this is to be treated as equity. That's a direct response to their learning about QSBS in 2018. But this law says that if you are an investor as part of the first $1 million in a qualified small business stock, meaning the term sheet you invest in is a right legal entity, and you're part of the first $1 million, and that startup fails, then you can actually deduct your investment as a write-off against your ordinary income. It's not treated as a capital loss, where if you understand how to do a tax return, then you offset capital gains, and then whatever the loss you take in a given tax year, you don't have enough gains to shelter, then you write off the loss $3,000 a year until you exhaust it. This allows you to deduct it, and that deductibility is called above the line or above the adjusted gross income line, which means it's a better write-off. It lowers
it means that you were getting essentially a 100% of, versus the,
right.
Usually it's like, if I'm making an investment, I'm only getting like the 60% of the dollar that I got to take home, because 40% of it went to the IRS before this. You're saying that that allows us to, I get a full dollar, I get a full, whatever the investment was.
Yes, it lowers your taxable income dollar for dollar to compute what's called your adjusted gross income line. And then charitable contributions, medical expenses, to the degree they exceed 2 or 3% of your adjusted gross, then you have write-offs. But a 501c3 or charitable contribution is a write-off below the adjusted gross income line. This is a write-off above the line. There's only a handful of them, but this is one of them, because it lowers your taxable income dollar for dollar before you compute an AGI, and then your itemized deductions are a function of a percent of your AGI. Anyway, long story short, this is a really profound decision. Again, when you think in terms of prospect theory, and then you align that with, wait a second, $500 billion was given away last year. What if that money was invested in startups and they all failed? Those same people would have a lower tax bill than if they gave that $500 billion to a charity, because these write-offs would lower their tax bill. It's a better investment for them to invest in a QSBS deal and have it fail than if they gave money to charity. It's a better financial outcome.
And then like on the upside, obviously the startup could end up becoming a really good investment, whereas at the end of the day, the charitable giving, especially depending on how the charity is organized, it's not necessarily going to ever produce a return. And a lot of times the charities just, use money that's donated to them for operations and it goes away, right? That's
a lot of money.
It disappears. Yeah.
I was a philanthropy consultant for 20 years. I've studied the philanthropy industry. I still follow it to this day. And about 85% of all charities should go out of business. They are in the business of raising money is all they are. They're not in the business of solving problems.
Yeah.
That's
too much money.
That's a fact. But so back to your illustration though. So let's presume, so now we've just lowered the after-tax risk. We've made this a good financial outcome. No fear of loss. We've just neutralized the fear of writing a check in a startup, particularly if you have some impact flavor, right? This is a heads I win, tails I win. If you're a green tech, invest in green tech companies, don't give to the World Wildlife Fund. It's a better outcome. You want to profit from the solution, or at worst, have a better write-off by trying to support innovative solutions to these, what the World Wildlife Fund is not really solving.
Yeah. Well, let me mention,
because I know the name. They may be really effective. I'm not being directed at them. I just use them as an example. So
let me take a little side note on that. So a good portion of the tech ranch community worldwide focuses on what we call impact innovation. We stopped saying social impact because a lot of times people didn't see clean energy in that. And sometimes, people would hear the word social and they'd be like, wow, is that socialism? No, I think that what Joe's saying is this idea of like impact, like, we have one of our companies from Austria that we heard from last week is, drive 6% more output from your solar cells as an example. And so money invested there, you're directly affecting the environment, right? You're putting something on the bottom line of the customer, you're putting something on the bottom line of the company, you're putting, and you're given this opportunity, right? That's so for those of y'all that are in the historical tech ranch community, especially whether in this country or across the water, then coming here for, landing your companies into the US, this is a really interesting way of approaching that. Tell us more, Joe. Like how do we sometimes I think some of the investors might not know about this as well. How do we
99% of them don't.
Yeah, how do we educate our investor and say, hey, put money in with me because it's gonna, I see your investment in this environmental charity. How can we actually have that money come into here, build a business model to detect that set of issues and drive some things forward? But tell us a little bit more about how we actually educate the investor.
Well, years ago, I used to lecture CPAs on these tax laws when I was still out in California. So I was an expert in the California CPA Society. So they could get continuing education credits by hearing me teach them about tax laws. And I'm not a CPA, a licensed CPA. And I am shocked at how many times I have to tell a CPA about these laws before it sticks even in their minds. So to answer your question, I don't think you can educate investors to make an informed decision on QSBS. Because lawyers, accountants, I have found it's very few people don't just shut down their brain when you start even talking about the tax laws. That's why I have an accountant to care about that. Well, most accountants don't even know about this. Trust me on this. There's 2 QSBS laws. If they know about QSBS, they know about the second one, which I'll talk about. But I'll bet you 2% of the investment in accounting and legal entrepreneurial community knows about the original one I just talked about. That's the one that's the oldest, been around the longest, and defined what a QSBS stock is. Now, that's section 1244. Gives you write-off if the startup fails. Classic fiscal policy to stimulate investment by de-risking it with the tax code. The second one was a give back to the venture industry, passed in '93, when the VC industry wrote Bill Clinton a whole lot of checks when Clinton came out to Silicon Valley for campaign donations. And this was the give back to all those campaign donations he got in the '92 election. This says, okay, what if the startup is successful? Well, the QSBS under section 1202 says that if you've invested in a QSBS term sheet, and by the way, it doesn't even have to be part of that first batch of $1 million. It could be a later stage round. But if at any of the rounds you invested in, from the time you invested to the time there's a successful exit takes 5 years, then all the investors in that term sheet or any of them that they've been in it 5 years and a day pay 0 taxes on the first $10 million of profits that each shareholder extracts from the company. Tax-free profits. So
Amazing.
simple knowledge of the QSBS tax laws lowers the after-tax risk to stimulate investment and makes that investor, again, in a true prospect theory, makes them look like the smartest person at the country club because I don't have to pay any taxes on my angel investments. Their fear of looking stupid just not only got negated, but we get to serve a little bit more of a Maslowian ego gratification by being the smartest guy in the room.
Yeah, look at my bottom line. Exactly. Yeah, that's amazing.
Yeah, my profits are tax-free. These are all really relevant when you really understand why investors write checks.
Exactly.
When they're already rich.
Yeah, it's interesting because
and you've got to give them the ROI they seek. And sometimes they don't even know how to articulate it. What that ROI is they're seeking. It may be personal ego gratification at the country club. That's most angel groups, by the way. Most of them are to try and posture with each other. It's social capital is what they seek by joining and involving themselves in angel groups.
I've seen that in some of the
social capital.
Yeah, it's like instead of having a golf game, they're like, well, there's been a couple of different angel groups that I remember sitting in the back of the room, like looking at, and instead of, going and pushing everyone in golf or whatever, it was like blood sport for entrepreneurs and stuff like that. But yeah, this is actually interesting because you can take all that energy and that cash and actually direct it in a way that could be productive for entrepreneurs, especially
and give them that social capital they want, which is what motivates angel investors.
Yeah.
And again, in managing money for wealthy people, when they would come in and they would talk about why they're hiring me to manage their money and all those investment objectives, I let them get whatever they wanted to say out, but I knew it was the second or third level of questions and answers is really going to tell me why they're there and why are they meeting with me, because they're already rich. We had a very high minimum.
Right.
You're just that first blush, and angel investors are the same way, and VCs are. I don't even want to talk about them, but it's particularly early stage investors when they're spending their own money and writing the check themselves. It's not their due diligence questions are all theater. The second, third tier is where you start understanding what's motivating them. So
that's interesting.
You get some hands up now, so maybe we.
Yeah, let's do this. So we have a couple of questions that came into the chat. I'm going to start with those, and then we'll go through a couple of those, and then we'll go to Jay Fraser, and then if there's anyone else that has some as we process this, I think we hit the top questions that I wanted to ask. So I'll start interacting with what y'all post in chat and come online. So RD asks, has Joe written any books, articles? I don't see a website with just his name on it. Joe, where can they learn more? Yeah, well, and we'll put this into the show notes, but how would you like to, how can people follow up on details of what you're up to?
I have written a fair amount and posted on Medium. So you can find me on Medium. A lot of this psychology, in fact, these illustrations I'm talking about, it details on these QSBS tax laws. I've had some academic white papers published in prestigious investment journals, specifically institutional investors, journals of private equity, and journal of portfolio management. That's all there on my Medium page, and several articles incorporating a lot of this in investment thesis and strategies. So let me do this. RD, go look for that and let's post it into the chat, and then we'll also make sure it's in the show notes. So Bill Gorham now asked the question: after the first 1 million in QSBS, are there any prorated tax benefits to the next investment, say $1 million plus the 3 million? Great question. It's really interesting. I've been lobbying as a one-man band and with trying to get some other folks in DC. That $1 million threshold was established in 1978. So that threshold should be about $4.2 million if we just indexed the tax law to inflation. The original threshold back when the law was passed in 58 was $500,000. And then in 78, they said, wait a second, inflation makes $500,000 in 1958. What's that worth in 1978? $1 million.
Yeah.
They index to CPI. We haven't indexed that threshold since 1978. I've been trying to get somebody in Washington to care enough to say, wait a second here. If we just indexed it again, I've got a white paper, position paper on this that I've sent to people in Washington, D.C. I even extracted legislation out of the Revenue Act of 78 when they indexed it the last time. I did all the calculations for them. All they have to do is, if they're really serious about mobilizing more money for startups, index QSBS section 1244 one more time. That would make it over $4.1 or $4.2 million would qualify. So in a lot of part of the country, that's the seed round and the A round, and maybe, maybe touching the B round, depending on the business and if you're in Iowa or not. But point being, it would mobilize a lot more money, apply for a lot more folks, and just draw attention to the fact that impact investors can now be the smartest investors in the room, even if they lose money on the things they're funding.
Yeah, I know
It
exactly.
makes them smarter financially than the people that write stupid checks to these nonprofits that don't deserve it.
When it's especially true for the investors that maybe they made their money in one industry, I'll say like real estate or oil, and now they're, technology startup curious. This is really powerful because, it's like a lot of times, money that's been made over here, they really want, they know this style of business. It's real hard to, move that wealth to look over here. I think this is an exciting story just because of what it represents from that standpoint.
Yeah, and back to Bill Gorm's question, once the $1 million threshold's been exceeded, then no, there's no more QSBS section 1244. Now, what's interesting is, let's say, for sake of example, you raise $250,000 from friends and family. They're all protected. That's the good news for friends and family, is you're de-risking it for them right up front, which is really valuable to message to them. As long as when they invested, it's a qualified term sheet, you're a C Corp, et cetera, et cetera. But now you're going to go out for some money from strangers, and you've already raised $250,000 from friends and family. Now you're going to go raise $2 million. Well, $750,000 of that $2 million will still qualify for that favorable 1244 treatment. So that's a great way to stimulate that first money in by saying, look, we've still got runway on our QSBS treatment. So you want to be part of you want to hurry up and write the early checks.
Yeah, that way you have the protection, right? That's beautiful.
And that's a way to create real FOMO. It's not false sense of hurry up and write a check. It's here's the tax laws.
Yeah, it's not fashion. You're actually saying, this rock so hard, water is wet, and this investment is protected on the top line.
Exactly. The first $750,000 gets this favorable tax treatment. Now, what you can do is, let's say somebody comes in and says, okay, I want $1.5 million of that $2 million round, right? You can actually prorate that $750,000 across the whole amount of money you're raising, or just give it to the first folks that do write that next $750,000, or the first seven in that round. So you have flexibility on how the 1244 treatment is applied to your cap table when you have the amount of money straddling that $1 million and then beyond in your example. So
that sounds great. Let's go to the next question. This time, I think Jay Frazier wanted to come on live. Jay, did you want to ask your question live? And then we've got a couple other ones that I'll read in the chat. Go right ahead.
Joe, in one of your sessions, you were speaking about QSBS relative to founders stock.
Correct.
Can you expand on that?
Yeah.
Please, or just repeat it for the group.
Sure. The 1244, that first one that de-risks that first $1 million in, only applies to outside money. So founders stock, or the bootstrap money, or your paid in capital, the money you put in as a founder doesn't qualify for that favorable write-off. Only outside money. It was originally built to stimulate outside investments. That's the original 1244. Now 1202, the favorable treatment on an exit or profits, applies to all shareholders, including founder shares. So 1202 applies to founder shares. 1244, the first one, does not.
What I took away from your meeting, or what you said in the meeting that I attended that time, was that founders stock is tax free up to the first $10 million.
That's the second tax law, upon an exit. That's correct.
Upon exit.
Upon exit.
So if I sell my company for $50 million and my share of that is 10, I get all of that 10 tax free.
Yes. Now the law specifically says, let's say for sake of example, you put in $2 million and you have an exit for 50 million. The tax law says the first $10 million of profits or 10 times your cost basis, whichever is greater. So if you put 2 million as a founder in, that's your cost basis for your founder shares. Now you have $20 million of profits potential that you don't pay taxes on, because it's 2 million, 10 million, or 10 times your cost basis, whichever is greater.
Suppose my founder stock didn't cost me a penny.
Doesn't matter. Then you got 10 million.
That's what I thought.
Yeah.
That's what I'm planning on.
Excellent.
There you
Go knock it out of the park with that battery technology, Jay. We'll go to the next question. Alejandro asked, what are some examples of the second and third tier questions you just mentioned that would tell you the motivations of an investor?
Boy, howdy. Much like a presentation like this, I never went into any meeting with an investor with any sort of list or check boxes I'm looking for. I would always try and go in completely in the moment and present to read them. So it's kind of hard to give you those, but you can almost dissect it in just almost periods of time, because investors are going to do a dump, right? If you're an entrepreneur, they're going to want to brag about the stuff they've invested in, or they're going to get a bunch of shit off their chest. Always happens. They may ask you, what are you working on? You'll say about 3/4 of it, and then all of a sudden they're going to go, blah, because they're going to talk about their background, how they made their money. They're going to fluff their feathers. They're going to have to get stuff off their chest. They're going to talk about what they look for. I look for great teams and blah, 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 blah. All that's bullshit. It's all bullshit. You sit back and you just listen. And then you find something where they mention something 2 or 3 times. And you circle back on that. You say, well, I heard you say blah, blah, blah. Whatever the hell it is, but that forces you to be listening. Don't think about what you're waiting for them to shut up so you can hurry up and talk. You got to listen. And just know that first thing out of their mouth, once they exhaust themselves, it's all bullshit. Then the second question is, you're going to listen and try and drill down on something they mentioned a couple of times and scratch below that surface and find out the experience that drove that perception or why they commented on it. And now you're going to start finding the information. That's the second tier question. The third one is after you ask a question from the answer they gave you to that.
And there's something I'm going to make sure I reemphasize that Joe just said. Yeah, we say it around the Tech Ranch. You have to have 2 ears and 1 mouth, and you should be speaking and listening in that ratio at least. A lot of entrepreneurs, when they get put in front of investors, just want to present. They want to present. They want to present. They want to present. They want to present, and we're like, shut the you know what up. It's and find out what's important on the other side. Joe just said that. I just wanted to make sure I emphasize that. And we'll hop in with the next question. So Victor Brown said, please share your insights on the opportunity for independent film producers to raise money and complete their non-SAG AFTRA projects during the actors strike. What do you think about that question, Joe?
Well, I mean, there's a lot of real detail in that question that I'm not qualified to answer. That whole post-SAG thing you were talking about, I understand what's going on, but I have no idea how to answer that part of the question. One of the things years ago when I managed money, the accountant for one of my clients, wealthy clients, had a side gig where he was the controller on movie sites. So he was the one that literally paid the caterers and paid the daily stipends for the extras. He was the guy that literally almost had that calculator machine tracking the expenses that were coming in and pay. It's fascinating. And I got to know him quite well on the scene, and this is in the Bay Area. And he told me that a movie is just like a startup. You've got a vision, an idea. You're pitching other people for money. You're trying to pull a team together. You've got some competitive advantage. You're going to solve and satisfy an otherwise unmet need, which is getting this story. Because how many stories can be told in what different ways, right? Well, it's a combination of the chemistry of the acting, the quality of the directing, the quality of the narrative of the script. Oftentimes the storylines are all the same. They follow the hero's journey arc, that Joseph Campbell-esque hero's journey arc. The structure are all the same. The nuances are where the sex appeal is. And every movie is like an entrepreneurial startup. So to me, I think you can, to answer your question very directly, is that I think you think of the movie not as a work of art, but an entrepreneurial venture. Don't think of it as a creative outlet, but in fact, an entrepreneurial venture. And then I think a lot more of those details, those answers just pop off the page. You just got to think of it in a different context.
Makes a lot of sense. So Deonta sent me a note. She didn't raise her digital hand yet, but she said that she wanted to come on and ask you a question. We'll have her go next, and then we'll get to Richard's question and Robert's and then Bert's. Deonta.
Thanks, Kevin. Joe, what a font of wisdom you are. And it's like, it's also hearing things, these truths that I've concluded over a number of years running an international nonprofit organization. And it's like, wait, why did I not go and read and find you earlier? That's on Kevin, because he's known you, I do not know how long, and I've known Kevin the entire time of running Rainforest Partnership. So the first thing I did when I came on was I was the only woman until I think Marcella joined. It's a very lopsided world. The people who do most of the funding, the numbers you look at, whether it's a for-profit or a nonprofit, when you get to international nonprofits, the number I've heard, and it was during the pandemic, quite shocking, less than 1% of philanthropic dollars actually go to women-led organizations. And it was a very shocking number for somebody like me, because most of the people I knew were women running these incredibly impactful, the 15% that's actually creating the impact.
Mm-hmm.
So what is it that you would tell us from everything you've learned over the years? And I am going to go read up a lot about what you've spoken about, because this is my quest at this time, because the planet and the state of our planet, climate change, biodiversity loss demands it. So, and I imagine that all the people here will actually benefit from what you have to share.
Well, you're extraordinarily generous, and thank you. I do enjoy this format because I'm a compulsive researcher on a variety of subjects. When it's something that was put in front of me by a client, they'd ask me, hey, I wish I knew more about, I'd go research and become their expert. And philanthropy in particular was interesting to me because my family was a very modest background. My father was an alcoholic. He died as a derelict street person. Mom remarried, and they did very well in life. He was Portuguese, or is Portuguese. He's still alive. He's 89, and they did very well. He's first generation American. His both parents came over from the Azores, so it was and my mom was born in Oklahoma. She's an Okie, right? And literally my grandmother cooked on a wood burning stove, and they had an outhouse. So, again, in studying wealth, even in my own family tree, these topics are interesting to me. And then we had some friends that were very wealthy, but they liked us because we didn't give a shit about their money. And I heard about philanthropy through them and the social status that comes from being on charity boards. I don't know what the hell a charity board was when I was growing up until I got into college, right? So this has been fascinating. And as it relates to the gender, I've studied this because I had two older sisters raised by a single mom till she remarried when I was in college. This gender issue is really important to me. I have two daughters, both of which are very smart, very entrepreneurial. And it's a very complex issue. As it relates to philanthropy, I think the numbers, and I use that word carefully, I think, because I think these are laws of nature. I don't think it's specific to philanthropy versus entrepreneurial venture / women-led startups. I think these are sort of Fibonacci type ratios and laws of finance, of numerical nature, if you will. Women tend to, certainly in startup land, this has been well documented. Women tend to pursue smaller initiatives. Men gravitate to size because size feeds our male ego. In the world of being a man, size does matter. It's the alpha male. Who's got the biggest antlers? That's who breeds, right? Whether you're a deer or an elk or a fill in the blank, or who's got the biggest tusks. Size matters to be identified as the alpha male. So men gravitate to size. Women, by their very nature, this is not pandering. God bless them for it. They're the caregivers. Their strength ours is physical strength from an evolutionary biology standpoint. Women is emotional strength because they need to have the emotional strength to help procreate the next generation. That's a hell of a lot harder than going out and killing animals and dragging it back to the den. Raising a child is a lot harder. That's why women have more emotional strength. So when you look at and a person who's just brilliant on this, by the way, she's an evolutionary biologist, is Heather Hang. Heather Hang and Brett Weinstein are husband and wife, both evolutionary biologists, both two of the smartest people on the planet. I love them dearly. Heather Hang's done phenomenal writing on this from an evolutionary biologist standpoint, from a gender lens. The scientist on this, and she talks about some of this stuff as well. So to answer your question, in this was data that came out of the Koym Foundation, an impact event I was attended, and Koym presented on it. They sponsored it. It was in Denver about 5-6 years ago, and they presented this data. And I've heard this validated in the marketplace, at least in the world of startup and venture funding. The data says that women get about 2 to 3% of venture dollars. Women-founded startups get about 2 to 3% of venture dollars. That's yes. All right, 2 or 3 doesn't matter. 1.5 to 3, it doesn't matter. It's a fraction. Now, this is an important point. If you look at the number of female-founded startups seeking capital that get capital, okay, what percent do you think of female-founded startups seeking capital get capital? Anybody have a guess? And your guess?
I'm going to be very high. I think it may be 30 to 50%, somewhere crazy numbers.
Well, from this data, this report, this is 5 years old. It could be better. It was 10%.
Ooh,
that was the number.
Okay.
Now, the number of male-founded startups seeking capital that got capital, what percent do you think they got? It was 10%.
Oh, interesting.
There's no bias. The number seeking capital got capital, same exact statistic. So now you look down and say, okay, if it's not bias, what is it that causes women to only get 2 to 3% of venture dollars? Because that's a fact. But also it's a fact that there's no bias in the number of women seeking capital that got capital to guys.
They're not asking, or they're not.
They're not asking for as large amount of money, and there's not as many women starting startups.
Or even having access. So one of the things like playing golf.
No, don't
really?
call it access. Don't call it access. These are just the statistics. Why you're asking, you're trying to define why, and I don't think why is important at this stage. It's what we need to understand.
The numbers are the same, and you're telling me what my son said about chess grandmasters. Number of grandmasters, chess grandmasters are very few. And then he comes back to me, my 20-year-old plays chess and he's pretty good. And he comes back and he says, the number of grandmasters per the numbers of chess players is the percentage is the same. It's just that women and young girls are not playing chess, and you're saying the same thing.
Hey, so Nyanta, I got a question for you that I just have to interject. So one of the things that we're going to start doing with these programs is start sending out surveys at the end of each week, just to say, hey, what'd you like? What would you like to see more of? But one of the questions I'd like to ask you while we're in the middle of this discussion is, it's a free program. It's every week. I've personally donated to 3 different women entrepreneurship programs.
And why are they not coming?
Why? What do we have to do to get more women involved? Since you brought that up at the very beginning.
Why don't women show up?
Why?
And they are. So I will tell you where women show up. They go to other places where there are other women.
Yes,
I know this.
Yes.
And it does not make sense. And one of the decisions I made last year is to go to places where I was the only one. And so that means I'm the only one. So I went to Consensus in Austin, and I was the only, there were 2, I think, NGOs that I met.
Right.
Out of people all over the world. I did not go to the 2 COPs, the climate conference on climate change, even though we're observer delegates, have that status. Didn't go to the one in Montreal for biodiversity, because guess what? I was going to talk to the same people. That wasn't so much about women, but it was the same people.
Right.
And so I think there is a messaging, and I will talk to you about this, Kevin, because I need to think more about what you're saying about the numbers, Joe, because that is hugely enlightening.
Yeah.
What you said about those 1st, 2nd tier, 3rd tier, the complaints we have, and it's terrible to say this. I'll tell you this, a number of years ago in Austin, there were things that happened to me. These men with a lot of money, and by the way, I know a lot of men and women, but mostly men who are millionaires, billionaires with huge, but they don't write a single penny. So they're good friends sometimes, you know. It's we have relationships, like very strong bonds, personal bonds. That has nothing to do with this idea that just because people have money, they're philanthropic or they will invest. No, that's not the case. Okay. But this idea that women, you know, there were some people who would sort of make a point of grilling us. We used to have meetings in very public places where entrepreneurs or wealthy people in Austin that Kevin knows would actually meet and grill. And of course, I know my shit. And so then I thought they're doing it with me, but here's the thing, they were doing it with other women. It didn't matter.
Of course, look at that. This is a.
Well, what I'm going to do is I actually would love to, Nianta, I'm going to challenge you to put together, I would like to have a panel on one of our programs, since we're coming to the end of our time, and I'm getting all these messages from people saying,
oh, they want to hear something else. They're like,
no, they're having to leave. They're having to leave because it's we've gone an hour. And so what I'd like to do is, Nianta, I'm truly interested in engaging around this subject, and I'll ask Joe to come back because he's got the stats. But Nianta, let's put together an engagement during this program, because, yeah, like I said, over the last 12 years, I've personally donated, a significant amount of my time and money to 3 different women entrepreneurship programs, and I don't know how to engage. There's an interesting vector there that I'd like to open up a conversation around. And I'd like to, before we run out of total time, I'd like to get Joe one more question from our studio audience and say thank you, Nianta, because I think it's an important issue. There's 2 main issues that I hear here in what you're saying, about engaging women entrepreneurs. And the second thing is since you have an organization that's historically been a social concern, that now there's a possibility of engaging around a business model to drive the same type of thing. I'd like to dig in on both of those topics as we have a time in the future, for sure.
And Nianta, just to give you a little, maybe a ray of hope, what my company does is we've solved for this problem, by the way. Yes. So that it doesn't matter what you look like, what gender you are, where you went to school, all those subjective biases that fuel that male ego to bust your chops because they can. It's a completely meritocratic path to funding, regardless of where you're located, regardless of, it's that equivalent of, justice is blind. Well, funding entrepreneurship should be blind as well. We built a platform to execute that. So.
Excellent. Let's do this. Joe, I'm going to try to sneak in one more question. I know for those of you all that are having to leave because 12 o'clock meetings have started, or, whatever might be taking you away, just I want a real quick reminder. We're part of what happens on our community site after this is we typically ask our speakers to stick around and answer questions in threaded discussion for about a week after, and then they might disappear. There are a lot of times people send me a note saying, hey, I'd really like to talk to Joe one-on-one, but Joe doesn't necessarily want to be processing lots of questions and stuff like that. And I mean, a lot of times when, especially as this gets more exposure to a larger group. So I'm going to invite you to join our community, and we'll go ahead and take one more question from the chat before we close up. And then there's a couple other questions that came in as well. I'm going to have Jello post those into the community site so we can follow up and have Joe interact like that. And Joe, by the way, part of what we'll do is Jello on my team can do all the heavy lifting for you so that you're not having to spend too much time on that, because that's part of what he does, is his position. But for those of you that are not in the community and you want to follow up on the after discussion, there's no charge to do this. Go to techranch.com/connect, and there's a link into the signing up for the community site for free. There's also a few other links, and since I'll be talking about this, usually I do this at the very tail end, but since we're going to go just a little bit longer on our time, the other things is there. You can sign up for our newsletter. You can sign up if you're interested in our country manager program, and there's a whole set of details about that. Look out there. You can find out more about bringing this, connecting this work into your part of the world. think we have up to 15 countries right now that are actively doing things with this work. And so that's partially what's there. But Joe, I'm going to ask you one more question. And like I said, we'll take the other ones that come in and we'll post them onto the site and ask you to, at least spend a couple of days to answering over the next little bit.
Not a problem. I may be answering it at 5 in the morning because I get up early just because. So I'll be
Yeah.
happy.
Well, the best part about Jello is he'll be happy to do that because he's in the Philippines. So I always force him to stay up so late. Okay, so Richard Hurley asked, talk in the Financial Times of A16Z going to Abu Dhabi to find investors. Have rising interest rates clipped the wings of investors in Silicon Valley?
Yeah, I'm 61 and I've been studying the venture industry from a front row seat for almost 30 years now. Well, I guess it is 30. 93 is when I took over that multifamily office that was there at 3000 Sand Hill. And all I see is the same behavior from different generation of VCs. So I saw the bubble of the 90s and what behavior happened. And if you again go back to and understand, if you see some of my writings, you'll see that I'm a real cynic on the modern era of the venture industry, i.e. post 93. Because I saw it happen there at 3000 Sand Hill, where all of a sudden after the internet commercialized and easy money was available, if anybody can call themselves a VC, all the MBA students that used to go off to investment banking or consulting now call themselves VCs and could raise a fund because they went to Harvard and or worked at Goldman. And then all of a sudden chase these stupid deals. And then when things blow up, they leave the industry and we go through the same goddamn cycle again and again. We're going through it again right now. So I don't think it's just interest rates. I think it's bad venture behavior that they're all, of course, licking their wounds, and most of them will thankfully get pushed out of the industry. We'll go through a natural consolidation yet again. Andreessen themselves, I was around when Kleiner Perkins was God. Sequoia was this nice little scrappy VC firm, and Andreessen was still in high school, I think. But Kleiner was God. And then Kleiner blew up. Now we're seeing Andreessen and Sequoia blow up. We're going through the same patterns.
Yeah.
Okay. If you saw, Sequoia just broke themselves up into 3 pieces. Mike Moritz, the smartest of the second generation of Sequoia general partners, he just retired. These are all signs of what you're seeing as Sequoia is going away in its exalted status, and Andreessen is as well. These are just natural cycles. So I think it's far less applicable to quote unquote interest rates as it is to the sad state of affairs of the venture industry itself. It's just a new crop going through the same cycle.
It's there's also a Texas expression, since we were talking about Texas before we started broadcasting. There's a Texas expression that says, pigs get fed, hogs get slaughtered. And I think that if I was to, better than me, the industry, because you really have studied investment, whereas my background's more innovation. But the thing that I see on these cycles is, some of these funds, just like Austin Ventures did the same thing. It was a pain in the butt to try to raise funds years in the 90s here. If you weren't in the cool kids club, which, even though I did some amazing breakaway work, I wasn't in the cool kids club, and I had that same problem. And then AV hit the wall, and some of us, I don't mean to be obnoxious, but some of us were like, well, yeah, it's like you have to make space for the people who are going to innovate. So,
well,
yeah.
The sad state of affairs, and this is part of my writings, part of what we're trying to solve for, is the venture industry is the last financial services industry where there is zero professional standards, zero barriers to entry, zero training required to call yourself a VC.
Yeah.
There's no body of knowledge they have to study to become an educated venture capitalist. There's no continuing education that keeps their knowledge current. Hell, hairdressers have to go to beauty school and then they get continuing education to keep their license current as a licensed beautician. That is more rigorous than the venture industry.
Yeah.
Now that is who entrepreneurs have to pitch for money. And these are the people that angel groups are oftentimes trying to emulate. And yet those VCs literally don't know what they're doing. By definition, they've always rationalized that absence of a professional standards by calling it's an apprenticeship. Well, prior to 93, it was. You had to work at a VC firm oftentimes for 10 years to learn what to do and most importantly, what not to do before you thought you could go off and start your own fund. And after the internet commercialized, money was flowing and the bubble bursted and the party started and anybody can launch a fund.
Yeah.
And that's the loudest voice, the biggest cult of personality got celebrated in the media and the money flowed and the bubbles burst and then those people left. And then you have another crop attracted to that same cycle with just a new generation of innovation. And that keeps repeating itself because of the absence of professionalism. So we're literally bringing professionalism to how we fund innovation. As I like to say, we're finally bringing innovation to how we fund innovation.
Yeah, so let's do this. I mean, I think that since we've gone over a little bit from what I asked you to time wise, why don't we just use that as give us a few more closing notes, anything else you'd like the individuals to know that listen to this, how you'd like to engage. And like I said, I'm going to ask you to be involved in the community site on this one thread for the next week. Just, if anyone wants to do follow-up questions, and we'll get Jello to help Joe out to make sure that that's simple on him. There in the chat session, there's a link to the how to sign up for the community. Joe, any closing words that you'd like to say before we wrap today up?
Oh gosh, it's such an important and big topic that I've cared about for so long. It's hard to summarize it, but for those entrepreneurs that are on this call, you should aspire to be better. And better means, I like to call it more adult. Look up the word fiduciary and understand what that means. If you're asking for money, you are instantly putting yourself in a position of being a fiduciary over somebody else's money. Understand those responsibilities. Most entrepreneurs need to grow up in their behavior. Stop trying to sell a dream or sizzle and hope to God you can gamble with somebody else's money and it sticks and now you can call yourself a successful entrepreneur. Think more like a steward of somebody else's money. For the investors on this call or aspiring investors, the advice I give you, grow up. Stop viewing this as a gambling casino so you can fuel your goddamn ego. Give you something to brag about because that is how people behave, including most VCs. I'm talking about 90% of the transactions, maybe 95% of the transactions that take place are completely, almost entirely against sound investment practices. And if it's coming from a venture fund, they're violating their fiduciary responsibility over those other people's money, their LP's money. So it really comes down to growing up because there's plenty of information on how to grow up. What does grown-up behavior look like as an entrepreneur? What does grown-up behavior look like as an investor? And yes, I'm happy to offer up any and all supporting research and information for as long as it takes, a week or more, for those that actually want to learn how to grow up, whether you're an entrepreneur or an investor.
Well, thank you, Joe. I appreciate that because every time that I've been around you in the last 10 years, I've learned something each one of the times. One of our community members, R.D. Childers, has grabbed some of the links. We'll make sure those are in the show notes that'll be published out into the YouTube, as well as typically a lot more interaction happens inside of the community site. So if you're not in the community, it doesn't cost anything. All we ask is that for anyone who joins the community, there's some like, how do you take care of yourself? Like, just be a good community member. Don't, grow up in that as well, right? I appreciate, Joe, I appreciate your insight because like I said, as an entrepreneur, I've been doing this for a few decades, 3 decades now, but I always learn from you, especially in this relationship with investors and how to manage different aspects of that. We'll definitely have you back. And I've got like at least 3 different other topics that I was writing down. And I'm like, oh, we got to get Joe back for that. And we'll definitely, I appreciate your time and insight. It's always a pleasure to get to learn from you.
Happy to. It's fun I do have a bit of an educator bent in me. I'm actually teaching. I was asked to teach a group of the students at this new university coming into Austin called University of Austin. And I taught principled venture investing, but from a first principles, philosophical principles, how to do it better. Better is not just defined by economic metrics. And this is something I've cared about a long time. So thanks for having me. And give me a voice.
I'm going to follow up with you, make sure I can go sit in the back of the room, at least to listen into those lectures as well. So thank you. All right, well, so what we'll do is we'll go ahead and wrap up really quick. Thanks for sticking around a little bit later for everyone. We try to be an hour, but obviously when there's really cool subjects, we go a little bit longer. The conversation from here, if you're interested in following up, don't send me an email. Don't send me a text asking for Joe's connection information and stuff like that. The thing to do is to go online, get on the community, and we're going to ask him to stick around. We're going to support him for interacting with his questions. Jello might end up posting that onto the threads just to make it easier on Joe. But if you have other questions, there were questions in the chat that we didn't get to. We'll make sure that we post that onto there, and we'll follow up from there. If you're not in the community and you'd like to be, it starts at free, both with this Venture Outfitter Weekly program as well as the community site. We did move off of the Slack channels we were having because Slack was getting expensive, and we moved on to a new platform. We're still in the process of booting up the platform. So if you kind of have that, if it has that new car smell when you step into the community, it's because it is new. But take advantage of it. We're starting to see really good progress on that. You can go to techranch.com/connect and you'll find it there. Or also some of you might go to techranchaustin.com. Both URLs work. They point to the same website. There's also other places to plug into. You should be on our newsletter because we have so much information to tell you about what's happening, especially that we're now finally beyond COVID and we're really cranking up things. There's a lot of stuff that we'll put in the newsletter on a weekly basis to let you know what's happening as well. Okay, well, so this is my closing slide. It's always a pleasure when we get to hear from experts like Joe. I learn every time I'm around him, and I just need to remember that I need to be around him more because I still got a lot to learn. But come learn with us. Let's work together on building our ventures. It's always my honor and pleasure to be a part of a community of entrepreneurs that are driven by vision and values. Let's go change the world for the better together. Y'all take good care, and see you next week.